Welcome to Ito Analytics, the platform for providing option analytics. This is Chapter 2 of Option Trading Tutorial Series. In this chapter, we will talk about option pricing and intuition behind Black-Scholes model. The first option contract is believed to have been established in ancient Greece in the mid-4th century BC. It is until 1973. Fisher Black and Myron Scholes published the Black-Scholes model. Market participants then have a stable framework for pricing and risk managing options. The core idea of Black-Scholes model is that by assuming underlying assets log return follow normal distribution, a mathematical formula can be derived for computing European option prices. The Black-Scholes formula takes the form of this equation. It looks complicated at the first glance, but for traders and investors, we don't need to memorize this equation in order to trade options. We only need to understand the intuition behind this model. To understand the Black-Scholes model, we need to first study the parameters of this model. There are 6 parameters in Black-Scholes formula: spot price, strike price, interest rate, dividend, volatility, and time to maturity. First 2 parameters are spot price and strike price. For call option, higher of spot relative to strike means more likely for the option to expire in the money instead of expiring out of the money. Thus, price of call is more expensive. This is exactly the property that allows traders to put on bullish bet on underlying asset with call option. For put option, higher of spot relative to strike means option is more likely to expire out of the money instead of expiring in the money. Thus, price of put is cheaper. We can also say price of put increase with spot going lower. This allows traders to put on bearish bet on underlying asset with put option. Next parameter is interest rate. For call option, if we compare buying a call versus buying the underlying asset, call buyer needs to spend less money as call price is usually smaller than the underlying asset's price. As a result, call buyer can earn risk-free interest on spare cash. Higher interest rate induces lower opportunity cost versus long underlying asset. Thus, more expensive the call option is. For put option, if we compare buying a put versus selling the underlying asset, put buyer needs to pay premium to buy a put, but underlying seller receives cash, which can earn risk-free interest. Higher interest rate induces higher opportunity cost versus going short on underlying asset. Thus, cheaper the put option is. For dividend, the impact on option price is the opposite of interest rate. For call, higher dividend means higher opportunity cost for call buyer because call buyer doesn't receive dividend but underlying buyer does. Thus, cheaper the call price is. For put, higher dividend means lower opportunity cost for put buyer because put buyer doesn't need to pay out dividend but underlying seller does. Thus, more expensive the put is. The next parameter is time to maturity. For both call and put, longer tenor means option owner has more time to capture the desired movement of underlying asset. Recall from option payoff diagram. Owner of option contract has only upside gain, but no loss at maturity. Longer tenor allows underlying asset to move in desired direction to a greater extent. Therefore, option is more expensive. The last parameter is volatility. Similar to time to maturity, higher volatility means potentially more profit for both call and put owners. Both call and put have only upside gain, but no loss at maturity payoff. Higher volatility of underlying asset translates to higher probability for underlying to move in desired direction in a greater extent, while all downside risks are eliminated. Thus, higher the option price. Here we would like to talk about an important concept in option trading, the implied volatility. Recall from earlier, there are 6 parameters in Black-Scholes model. Among the 6 parameters, spot, interest rate, and dividend are observable in the market, while strike and tenor are features of the option contract. This leaves us the volatility as an arbitrary parameter. Volatility parameter is the market participant's expectation on future volatility of underlying during life of the option. Implied volatility is the volatility parameter in Black-Scholes equation implied from option prices in market. Another important concept to talk about is intrinsic value and time value. For any option, we can say that option price can be broken down into 2 elements, intrinsic value and time value. Intrinsic value is the in-the-money amount of the option, which is the value that option owner can get if the option is being exercised this moment. Time value is the extra premium on top of intrinsic value that market is willing to pay for enjoying the volatility of underlying before expiry. For example, for a 1-month call option with strike $100, spot price at $120, and option price at $22. We can say that $22 of option value can be broken down into $20 of intrinsic value and $2 of time value. In this chapter, we came across the Black-Scholes model and the intuition behind this model. There are 6 parameters: spot, strike, interest rate, dividend, tenor, and volatility. Each parameters affect call and put prices in different ways. And here's the summary table. Among the 6 parameters, volatility is the arbitrary one. We call volatility parameter implied from option price as implied volatility. This is the end of Chapter 2. Like, subscribe, comment, and visit Ito Analytics website for more option-related contents.